Good afternoon, ladies and gentlemen. My name is Ty Black, and as you know, we are presenting an analysis of Chicago Bridge and Iron. Chicago Bridge and Iron is a global engineering, procurement, and construction firm that services the energy industry. CB&I is actually one of the largest in the industry, with revenues exceeding $5 billion and a market cap of $4.7 billion. CB&I is comprised of three main business segments, the first of which is steel plate structures, which create storage vessels for the oil and gas, nuclear, water and wastewater industries. The second is its engineering and construction segment. And the third is Loomis Technologies, which provides licenses to customers in the hydrocarbon, petrochemical, and chemical industries. CB&I is currently undergoing a major acquisition of the Shaw Group that will provide CB&I with considerable competitive advantage in the globally expanding energy market. The Shaw Group focuses mainly on the fabrication, maintenance, management, and the environmental aspects of the oil and gas, nuclear and fossil fuel power generation industries, and various government agencies. We currently have a hold recommendation on CBI with a target price of $54.35, which is moderately above the current stock price of $51.25. Next, Gary Shorts will speak to you about an industry analysis, competitive positioning, and the risks.
Thank you, Todd. All right, since we understand the three business segments, we want to focus on three main points for the industry highlight. First is global demand, which is dependent on commodity prices. Second is heavy construction industry, which is cyclic in nature. And third are trends related to the oil and gas, coal, nuclear, and other energy industries. Because of the Bakken Shale formations in North Dakota, the Eagle Ford formations in Texas, and the Canadian oil sands, this has allowed North America to capitalize on the extensive production of oil and natural gas. This has pushed North America past 14 billion barrels of oil produced and over 860 billion cubic meters of natural gas produced each year. Europe has recently experienced a decline in consumption of oil products, as seen by the chart, and this is due to a contraction in overall growth. Contrarily, the Asia-Pacific region has experienced a constant increase in the consumption of oil products, as also seen by the chart. This is because of a robust economy and an ever-expanding population. Natural gas. Because of the large supply of natural gas and the quantity produced, this has effectively lowered the price of natural gas in North America. This has basically allowed utility companies to switch away from coal-fired power generation towards natural gas-fired power generation. In Europe and Eurasia, natural gas must be imported in liquefied form and then regasified, near the point of utilization. CB&I specializes in this chain of events by building the extraction equipment, to the liquefaction equipment, to the steel plate structures building the storage vessels, to the regasification and peak jetting facilities. Coal consumption. Because of the shift from coal to natural gas in North America, this has led to surplus of coal in the world. This has allowed Europe to capitalize on this and increase their consumption of coal, as seen by the chart. Since the Japanese tsunami in March 2011, many countries have reviewed their outlook on their nuclear consumption. After all, this is not the first time a disaster has occurred. We believe in countries where, one, fossil fuels remain expensive, and two, countries which exhibit less risk to things like natural disasters may experience an increase in consumption in the next decade. Countries we believe which exhibit this are India, Saudi Arabia, China, and the UAE, with China possibly expanding its nuclear output to 150% of its current output. We believe the steel plate structures will be its most likely profitable sector in 2013, as there is continued demand for storage vessels, not only for the liquefied natural gas segment, but for also crude oil storage. This is followed by the engineering construction segment, which demand will continue for the extraction platforms, while Loomis Global will continue to provide its customers licenses in the hydrocarbon industry. Finally, Shaw represents a step in global diversity towards nuclear and fossil fuel power generation, pipe fabrication, environmental aspects, and work for various government agencies. CB&I's competitive positioning extends in two main aspects. First is its services, which include feed, or front-end engineering and design, and modular fabrication. These are two things many of their competitors do not possess. Second is their position in the shale revolution, which has allowed them to capitalize on global energy shift and the trends in liquefied natural gas. Finally, we believe the three main risks for the company include economic fluctuations, the risk from competitive bidding, and environmental and safety regulations. Next, Adia Khan will speak to you about the historical financial performance.
Thank you, Gary. One of the main strategies of CBI has been to grow through its acquisitions. For more than a decade, CBI has exhibited strong growth through its acquisitions, growing its revenue at a compounded annual rate of 20%. Long-term revenue growth was impacted by financial crisis in 2008. and as construction lags economic cycles, this impact was realized in 2009 and 2010, with its revenues declining by 23% and 20% respectively. In 2011, revenues increased by 25%, almost returning to its highest level in 2007, and a 20% increase for the 9 months in September 2012. The quarterly and year-to-date increase was driven by the liquefied natural gas, engineering, procurement, and construction projects. The company's backlogs have significantly increased, currently being at $9.5 billion, with a good mix of reimbursable and long-term projects. Each of the three sectors experienced a strong year in 2011, as evidenced by gross profits of 4.5%. Cost of goods sold had reduced from its high of 96% in 2008 to 88% in 2011, being one of the largest contributing factors to increased profits. Earnings per share have also increased at a compounded annual rate of 17% over the last 3 years, currently being at 2.86, and the company has only $40 million in debt, leading to a debt-equity ratio of 0.01, indicating the management's ability to deleverage the company in order to acquire more debt for the short transaction. As of September 2012, the company had more cash than debt on its balance sheet, being effectively a debt-free company. Following the Shaw acquisition, the company had total debt obligations of $1.9 billion and $800 million in cash, resulting in a net debt balance of $1 billion, representing just 50% of total market capitalization. Next, Aaron Rogers will talk to us about valuation.
We based our projections off management forecasts and laid out in the prospectus document for the Shaw acquisition. With these, we took their revenue and EBITDA figures and about $1.8 billion in pro forma debt. $1 billion of that is going to be in term loans at an interest rate of about 3%. $800 million is going to be in notes at an interest rate of about 5%. Now, historically, CB&I has large cash balances, so we anticipate this in the future and assume that they're going to keep out $800 million in cash, with the free cash flow going to service the debt. Now, under these projections, we came up with 3 base scenarios: conservative, moderate, and optimistic, and we sensitized them using synergies, 0, 50%, and 100%, where these synergies were identified by management as cost savings synergies and cost savings and revenue synergies from the Shaw acquisition. Now, in our projections, we saw year-over-year profit growth, as well as profit growth. All the debt was repaid by 2016, and in some of the more optimistic cases, it was repaid by 2015. And excess cash flow was able to position CB&I to acquire another company, should they so choose in the near future. For our valuation, we looked at 3 different methods: PE, EBITDA multiples, and discounted cash flows. We felt the most realistic scenario was going to be the conservative 50% synergies, which you can see revenues increasing from about $11 billion to $15 billion. And we took a list of 10 competitors and took a weighted average to come up with our PE multiples and our EBITDA multiples, which were 12.6 and 7.4 respectively. For our PE ratio, we took our earnings per share, projected earnings per share of $4.14, multiplied it by the 12.6, and came up with a share price of $52.10 per share. For the EBITDA multiple, we took the $930 million in estimated EBITDA, multiplied it by the 7.4, and came up with our $54.56 a share. Now, for the discounted cash flows, we used the weighted average cost of capital of 11.4% discounted to the present. We assumed a 7% market rate, 2% for the risk-free rates, T-bonds, or 10-year T-bonds are trading about that currently, 4.15% weighted, 4.155% pre-tax cost of debt, a weighted equity of 80%, weighted debt 20%, and calculated beta to be 2.3, which gave us $54.65. We assigned weights to each of these to come up with a $54.35 a share stock price, but that is only moderately up from where it's currently trading. It's actually about 6% higher, but we do feel that CB&I has good global diversification, strong current financial situation, and projected growth in the future, which is why we assigned it a hold rating. Thank you, and can we answer any questions?
Go back to those slides that contain 3 methods, the ranges, very conservative to moderate.
Yes.
just go back. Yeah, this next one.
Yes.
Go to the next one, Jim. I see very wide range between your estimation.
Yes.
I mean, from conservative to optimistic. Is this range acceptable or based on best practices? From 59 to 84?
Well, we pulled actually all these numbers out of the EBITDA and revenue numbers out of this prospectus. And in the prospectus, you had a CBI Shaw prepared management case, a Shaw sensitized management case, where you had the same revenues but lower EBITDA numbers. Then you had a CBI Shaw case, and then you had a CBI sensitized case. So these numbers reflect, and we chose conservative because it was the numbers that were created for Shaw by CBI as opposed to for Shaw by Shaw, because we felt that they may be inflating their numbers to try to get more money in the transaction. So that's where that range comes from. Where did you come
We calculated the beta using a 5-year historical monthly close prices for the S&P 500 adjusted for dividends, and we took it and plotted CB9 on the y-axis with the S&P on the x-axis, of course, and we took the same range of the dates for it's from December 2007 all the way through December 2012. Like I said, monthly close prices. We calculated a regression based on the change in prices, and we got a beta of 2.3 and a R-squared value of 154.
So that's the data for a standalone acquiring company. It didn't take into account that the risk profiles substantially change once the acquisition is completed, right?
No, this is only a current beta. This is not.
You're applying it to the free cash flows of consolidated performance. Don't you think that's an issue?
I can see how that would be.
How did you come up on the valuation that you only put a 10% weight to the PE and 45 to the DCF?
Well, with the EBITDA multiples, we actually, on the call with management, they said that valuation in the industry is predominantly done with EBITDA multiples. And I also felt that the discounted cash flows, they were subjective weights, but I also felt that the discounted cash flows as well is a good, one of a stronger method for value.
If you go to your earnings per share slide,
this one? Is this what you're referring to?
yes, it's that one.
Okay.
And one of the things that you said that, no, it's actually up one.
This one?
There, yeah.
This-
You said that really what drove the profit here was a decrease in the cost of goods. So, right?
Yes, ma'am.
Okay, did you continue that? Do you know why cost of goods sold went down tremendously? And if you did you also project that decreased cost of goods sold into the future, or did it come back to a more normal level or not?
I personally, we did not project that out, but I personally think COGS is going to stay around this range because since 2008, they've been working with diversifying and changing their contract structure, going away more from lump sum to the hybrids and the cost-free reimbursables. And right now, their backlog is split. I believe it's 55-45 between lump sum and cost-free reimbursable contracts.
Your pro forma equity market capitalization which increased more costly by $1.6 billion. How did you come up with that?
Well, I'm sorry, which?
Yeah, it's here, 5.6 billion pro forma. I mean, I assume that's post-acquisition, right?
Yes, sir. We got that on.
Or let's ask the question more, right? So, what's the current market capitalization of Shaw?
I'm not sure about Shaw.
On January 25th, it's 4.7 billion. Yeah. Okay. Yes.
Yeah, out of presentation.
Oh, for Shaw, I'm sorry. Shaw's 3.2.
3.2. So 3.2. I mean, that's either current market cap or the deal value, right? So if they take on 1.8 billion of debt, right?
1.8 billion.
1.8 billion of
Yes.
debt, right?
Yes.
Finance the acquisition. Then the remainder, call it 1.4 billion, right? Is equity, right? So in this scenario, you only increase 600 million, right? Which
Are you talking 600 million in what, debt?
no, I mean equity market.
Oh, okay.
Right? So essentially, they would destroy, 600 million of equity market. How do you explain that? Why would you do that even if you destroy 600 million? Share value.
To be honest, I'm not sure, but I can get back to you with an answer.
Sure. Very good.
All right, go down a few more slides to your evaluation using, for your weighting averaging, your PEs and your, and go up.
Okay.
I like watching, where you got your peer group, I guess.
Okay.
There we go. You say weighted
Yes.
average. What did you weight with?
The enterprise value.
So what's the difference between enterprise value and equity value?
The equity value is just, we adjusted it with their cash and debt. Their equity value adjusted with their cash and debt preferred stock, which,
Okay, so if a company has $1 billion of equity market cap, right? And they have $500 million of net debt, what's the enterprise value?
You said, can you repeat that one more time?
1
Sorry,
billion
I got-
of equity market capitalization, $500 million of net debt, what's the enterprise value?
Would it be 500 up?
1.5 billion.
Oh, sorry. Okay.
Since we're just saying you're not talking, I'll ask a couple of questions about this slide.
Okay.
Your peer group here, is
Yes.
this taking into consideration the peer groups of the acquisition or not?
Yes, we heavily focused on a lot of the competitors that they used out of the perspective that I believe it was Merrill Lynch that analyzed the acquisition, and that's where you pulled a lot of our competitors from.
On the risk matrix, which is probably about page 10, and you did a lot of stress testing on the conservative synergies, et cetera, but did you, how did your valuation take into account some of the items in here, especially in the, we'll call it in the orange blocks there?
How so? Can you phrase that?
Well, if you have a contract risk, I mean, how dependent is the valuation upon contract risk or economic cycles? What's the regression analysis to, we'll call it global GDP or whatever, metrics you would like to use or power prices?
Well, the company's fairly globally diversified, and actually, after the transaction, they should have about $26 billion in backlog. So we feel that the revenue should grow to come. These are obviously issues, but they're heavily diversified. They do a good job at integrating their acquisitions. And with the acquisition of Shaw, they'll cover 4 or 5. They'll have a very strong presence in 4 or 5 different industries to kind of mitigate some of that risk.
So, did you take these into consideration implicitly or explicitly? Or did you?
I did not consider these.
Okay.
Sorry. I did consider the fact that it would take time to integrate the transaction, and I did build in stair steps for these revenue synergies, so that, which is why some of these valuations are actually fairly low. Because actually, if I go down to this last slide, I can show you. Some of these are low because you can see actually here on moderate versus conservative 50% synergies. The moderate is actually a little lower because revenues don't really take off for them the way I have it built out until 2020. 2015. Thank you.